Hi folks, welcome to another video by Stocktrades. My name is Matt, and today we are going to look at the top energy stocks to buy in Canada. But before we do so, just a reminder, please subscribe to our channel, and throughout the video, don't forget to drop a comment. We love engaging with our subscribers, and comments is the best way to do so. And with that in mind, let's get right to it. It's not easy being an energy investor. In fact, it has been arguably the worst performing sector on the TSX Index. Year to date, the S&P TSX Energy Index is actually down by 50%. So really, it's a real tough environment for energy companies in general. So today, we're going to look at a handful of companies that we think might provide alpha or greater returns over the course of the next year or so. These are companies that we believe that if you're going to choose to invest in the energy sector, these are probably some of the best and some of the ones that you might be wanting to look at. These are by no means recommended buys, but we do think that they have the potential to deliver outsized returns in the event that the sector itself rebounds in a material way. So let's get right to it. And the first one that we are going to talk about is Parkland Fuel. When it comes to the energy sector, producers tend to get all the glory. And there is one industry that doesn't quite get the attention it deserves, and that is the distribution and marketing of fuels. That industry there has actually done quite well. And one of the leading performers, Parkland Fuel. The company has grown revenue by approximately 20% on an annual basis over the past decade, and it really has been a standout performer. This year, the company's stock is down by approximately 25%, and we believe it is a great opportunity for investors to consider jumping into the stock. I'd now like to bring attention to the fact that Parkland is a very diversified company. It has over 2,600 locations worldwide, the majority of which are in Canada, but it has been expanding. It has some of the best brands under its operations. That includes Chevron, Ultramar, Pioneer, Esso, and it is a leading provider of the on-the-run convenience store locations. Furthermore, if you look at the company's business model, you'll notice that no segment accounts for more than 35% of EBITDA, and it is equally invested in the commercial, retail, and supply side of things. So it is well diversified. It has a lot of opportunities and multiple channels for growth. The company also happens to be a Canadian dividend aristocrat. This means that it has grown the dividend by more than 5 consecutive years. I'd also like to bring attention to the fact that Parkland makes for an interesting income stock. It is one of the few companies that has managed to post double-digit growth plus grow the dividend at the same time. Typically, high-growth companies put aside dividend growth, and they focus on deploying cash towards growth opportunities. Parkland has found a rare blend between growing the business and paying a higher dividend. As you can see by this chart, the company has a decent yield, about 3%, and it has consistently grown the dividend over 8 consecutive years. Overall, if you're looking for one that's outside of the norm, we think that Parkland Fuel is one of the best in the business. Next, let's talk about an oil producer. We find it very difficult at this point in time to be investing in this industry. However, we recognize that there's a lot of interest by our subscribers. So we're going to throw a name out there, and that is Canadian Natural Resources. Why? We just simply think it's best in class. However, it's important to realize that the current environment is still quite bearish. Demand has cratered. The price of oil still hasn't recovered in any meaningful way. Dividends are being cut across the board, and there really is just a general bearish sentiment. We don't know what's going to happen. There still exists considerable uncertainty with the pandemic, so we don't know when the demand is truly going to rise and how that will impact oil prices. In fact, there are some that are now saying that peak oil was 2019. So we're not in the game of forecasting oil, but if you're going to pick one, Canadian Natural is the one to pick. Why? For a number of reasons. First and foremost, it is the best positioned in terms of generating cash flow. It is the lowest cost producer. Let's dig into some of the details. First, let's look at cash flow. As you can see, the company's free cash flow break-even point is estimated to be between $30 and $31 WTI, and this includes the current dividends. So that's actually pretty good. And at today's levels at around $40 a barrel, Canadian Natural is generating positive free cash flow. Secondly, on an operating level, it only requires WTI prices between $25 and $26, and that includes general maintenance capital. So overall, Canadian Natural is one of the best at generating cash flows. Taking this a step further, you'll see that their free cash flow break-even point and their dividends in relation to peers is actually much more attractive. In fact, you see here that they have one of the lowest break-even free cash flow points in the industry. So this is a company that is well positioned to navigate a low-priced environment. The other thing we want to bring attention to is the company's low debt profile. This is what is holding many of its integrated peers back. There are some very high debt loads in the industry, and Canadian Natural actually has one of the lowest debt profiles. So not only is it a lower cost producer, it also has one of the lowest debt per barrels in the industry. Once again, this makes it very attractive for us, and it also makes its dividend way more sustainable. Speaking of the dividend, this is a company that has grown the dividend for 20 consecutive years. Now, we know that in the current environment, a rising dividend isn't the be-all and end-all. However, in Canadian Natural's case, we believe that the low costs, strong cash flow generation, despite the current low price environment, the company is still well positioned to maintain the dividend and perhaps even come through with a raise next year if the prices of oils rebound. So overall, we just think that this is a company that is one of the best in the industry. If you're going to pick one oil producer, pick the one that has low debt, that has low costs, and that is generating free cash flow even at today's low prices. And that is Canadian Natural. Next, we're going to look at two midstream companies, and quite frankly, they are just the two best in class. That is TC Energy and Enbridge. These two pipeline companies are some of the best income stocks to own on the TSX Index. At first glance, you might be worried about their dividend because of their payout ratios, but we'll get to why we think that their dividend is safe in just a moment. First, let's take a look at their chart in comparison to their peers. Given their status as some of the best known companies and some of the most diversified pipelines in the industry, they have outperformed the majority of their peers. Whereas most of them are sitting on losses greater than 30% this year, TRP and Enbridge are sitting between 15 and 22% losses year to date. Now, this is by no means great. It is, however, still outperforming the TSX Energy Index in a big way. As we discussed earlier, the TSX Energy Index is down 50%. So they are outperforming the index by more than double, which is great. Let's dig into these two companies in a little bit more detail. First, let's look at TC Energy. What we like about TC Energy is the company's strong capital growth profile. As you can see here, it has approximately $37 billion in capital projects through 2023. Interesting to note that TC Energy gets a bad rep because of the Keystone XL pipeline, which has been mired in regulatory hell for quite a number of years. And recently, presidential candidate Joe Biden has come out and said that he will not support Keystone XL. So there's a lot of uncertainty around that program, which is, I think, holding the company back a little bit. However, it's important to note that TC Energy is not all about Keystone. As you can see here, it has several projects on the go, 5 billion of which are expected to finish in 2020. So this is going to drive strong EBITDA and future cash flows for the company. You'll see here as well that it is spread out across the liquids and natural gas pipelines. It even has some power and storage projects on the go. So this isn't a one-trick pony. TC Energy has a lot of projects on the go, and it is poised for considerable growth over the next couple of years, which is going to support dividend growth. These midstream companies make for excellent dividend and income stocks. One of the drawbacks is in a low price environment, investors are worried that the dividend may be cut. Not the case for TC Energy. The company has come out several times and said that its business has not been impacted in a material way by COVID because the cash flows are underpinned by long-term contracts. As you can see here, the company expects to grow the dividend by 8 to 10% through 2021. So that's through the end of next year. After which point, the company is going to grow by 5 to 7%, which is in line with the company's cash flows. So overall, we believe that TC Energy is a strong income and growth stock. We're not talking about a stock that's going to grow by 20% on an annual basis, but high single-digit growth combined with strong dividend growth makes for a very attractive stock. Now, let's look at Enbridge. The investment thesis behind Enbridge is very similar to that of TC Energy. The company's business model generates strong free cash flow. 98% of EBITDA is underpinned by regulated and long-term contracts. It also has a strong base of customers with strong credit ratings. It has also been focused on deleveraging, and current debt loads are within its targeted range of 4.5 to 5 times EBITDA. Good news is that Enbridge is even looking at dropping below this level in 2021. Which brings us to the dividend, because this is what is most important and what we believe the investment thesis behind Enbridge is super attractive. The company currently yields above 8%, which is very strong and much higher than that of TC Energy. And the dividend, although it appears that it might be under pressure due to a high payout ratio as a percentage of earnings, it only accounts for 70% of distributed cash flow, well within the company's range. This is a company that has raised dividends for the last 25 years. It is one of the top Canadian dividend aristocrats. It also has a targeted payout ratio of between 5 and 7% beyond 2020. It hasn't missed a dividend payout over the past 25 years. It consistently meets targets, and it has strong free cash flow. So leave earnings aside. Important to focus on cash flows here, and Enbridge has a safe and reliable dividend. And it's also a dividend that is likely to increase in 2021 and beyond. At levels above 8%, Enbridge makes for the most attractive income stock on the TSX Index and in the energy sector in general. Next, we're going to look at the best performing energy stock in 2020, and that is Tourmaline Oil Corp. Ironically, Tourmaline is actually not the biggest oil producer, but it is the biggest natural gas producer in the country. And one of the reasons why the company's stock has done so well is because the outlook for natural gas is stronger and more bullish than that of oil. You know, recently on Twitter there was a debate about natural gas versus oil, and one of my comments was, if you're going to insist on investing in oil gas, then in my opinion, natural gas producers is the way to go. And once again, I think Tourmaline is best in class in this area. So this is why I think that Tourmaline makes for an attractive investment if you're going to invest in the oil and gas industry. As mentioned, Tourmaline has been the best performing stock on the TSX Energy Index. It is up by approximately 8%, which is fantastic, all things considered. So why has it outperformed? It's because Tourmaline has been dealing with low natural gas prices for years. So this is not new to the company. Whereas a lot of the oil producers got hit quite significantly, Tourmaline did get hit, but it rebounded fairly significantly because the outlook for natural gas is improving. The IEA, expects that the spot prices for natural gas to average approximately $3.13 throughout the course of 2021, which is much higher than the average in 2020, which was $22.07. So we're talking about a near 30% increase in the average price of natural gas. This is what makes Tourmaline most attractive. If you look here, the company is actually one of the best natural gas producers in the country. It has consistently grown production per share since 2009. It has increased its reserves per share. And not only that, it has reduced its operating costs per barrel of oil, which is quite significant. So it is generating considerable cash flow here at these levels. You can see here that the company's cash flow per share has increased quite significantly over the past number of years. So really, it is really positioned to do well. And you'll see here in the notes that the company is profitable at prices, natural gas prices above $1.80 per share. So if the natural gas price remains at $3 as expected, this is a company that's going to be quite profitable over the next little while. Although the company does pay a dividend, it only yields about 2.76%. The investment thesis here isn't a strong and growing dividend. The investment thesis here is a rebound in natural gas prices, and as a low-cost producer, Tourmaline is well positioned to generate considerable cash flows over the next little while, so long as the price of natural gas does reach these bullish levels of approximately $3. So that's really the investment thesis here, and this is really why we think that Tourmaline is one of the most attractive plays in the industry right now. If you're going to invest in oil and gas, we think that gas is the place to go, and we think that Tourmaline is the best in the business. It's also important to note that Tourmaline is actually spinning off Topaz Energy in a $250 million IPO. It expects to use the funds from that IPO towards more acquisitions, in which the company has called a generational opportunity. So the company is really looking to expand here. So we think that not only is Tourmaline underappreciated due to the rising price of natural gas, but it does have lots of opportunity and is going to be aggressively expanding its portfolio. And with that, we're at the end of our video. We have 5 strong investment opportunities for investors, those who are looking to invest in the energy sector. We think that Parkland Fuel is simply one of the best distributor and marketers of fuels. It's also a leading convenience store operator. We have 2 pipelines, best in class here. Enbridge and TC Energy both provide strong, sustainable dividends. And we have 2 producers, Canadian Natural on the oil side of things, which low cost, low debt, strong free cash flow generation. And we have Tourmaline Oil Corp, which is the biggest natural gas producer and best positioned to take advantage of rising natural gas prices. Please let us know in the comments if you have any more options to consider for those who are looking to invest in the energy sector. And don't forget to hit the subscribe button for more great Canadian content. Until next time.